you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday, and guess what? We have power. So, yeah, if you missed yesterday's show, we apologize, but right in the middle of the show yesterday, we had a lightning strike outside, took the power down at the building, so we were cut off before we got to the end of the stream. Everybody's alive. Most of the equipment survived. But we're back in action today. Glad you're here. Make sure to like and subscribe to the channel. We certainly appreciate that very much. It does help us grow our channel, and our channel has been growing. We just crossed 32,000 subscribers. Thank you so much for that. That's all due to you. We appreciate that very much. So again, help, like, subscribe. That certainly helps us keep growing the channel. John Penn joining me today. We're going to have an interesting topic to talk about this morning because it relates, back to markets and investing. But a few other things that are going on right now, just to, kind of just keep things, kind of current. This morning, futures are pointing higher. So yesterday, the market sold off pretty dramatically over concerns about this whole Fed feud that's going on. Trump is laying the groundwork to blame Jerome Powell for anything that happens in the markets or the economy right now. By going back and saying, well, you were cutting rates going into the election when the economic growth was at 3%, but now you won't cut rates with the economy slowing down. He's setting up this whole kind of debate now about, is the Fed really politically independent or not? And so this really is starting to get interesting. But that weighed on the markets yesterday, again, because the Fed independence is very important to the markets. The Fed actions are very important to the market. And the markets do like Jerome Powell. After the last, this last term with him in particular, he has garnered a lot of favor with Wall Street. So not surprisingly, yesterday, this feud has kind of rolled over into the markets. But again, yesterday, what was important, is that the markets did sell off and sold off pretty large. We were down about 2.5% yesterday at the close. So it was a big sell-off yesterday, but it was very orderly. This wasn't like we saw previously right after the trade war announcement when Trump came out and announced these massive tariffs, we just had the markets just fall apart, and it was kind of a disorderly sell-off where things were just getting liquidated in just giant chunks across the markets. We did see that selling yesterday, and markets were down about 2.5%, but that was more orderly. It wasn't this just kind of random dumping of every asset across the board. So again, we did see that yesterday, but volatility was up just a little bit. It wasn't spiking higher. That was also encouraging. So it just kind of suggests that the markets are starting to calm down here a bit. We still have a lot of pressure on the markets currently in terms of equities, and we saw pressure in the bond market as well. So these kind of spats between the White House and the Fed certainly isn't helping any matters, particularly when you layer that on with this kind of trade tariff issue that's going on, and we really haven't had any announcements. And this is the challenge now for investors. It's really easy to be super bearish here and just go, man, I'm just going to be short the markets, I'm out, whatever it is. Be careful here, because this whole market is hinging on an announcement. If the Fed, if President Trump comes out in the next day or 2 or 3 and says, hey, we just cut trade deals with 25 countries, no tariffs. I'm just making this up. I'm not saying this happened. But if an announcement like that occurred, this market is going to rocket higher because it's so pent up right now and oversold. It is just needing a piece of good news. So be careful here, because as we saw just a couple of weeks ago where we had that 9% advance in like one day, that could happen very, very quickly here and kind of leave you on the wrong side of the trade. So, again, this isn't a structural issue with the markets right now. This is an event-driven market that's going on, and it's all circulating around these tariff announcements. And again, whatever comes from this, whatever announcement comes, this market's going to have a very, very sharp advance. Let's be clear. I'm just talking about a counter trend rally. You're very depressed here. You're going to get a counter trend rally. I'm not talking about a return to the bull market. So let's make sure we keep those, kind of separated at the moment, because those are two very different things. Longer term, this market's still going to have some work to do. Doesn't mean massive bear market, but have some work to do to work through slower economic growth, disinflation from tariffs, etc. So we'll deal with that, but just be careful with markets as deeply as oversold as they are right now. You're going to get a reflexive rally to sell into, add more shorts, raise more cash, etc. So just be careful making a knee-jerk reaction here is kind of the point. But let's talk about kind of where we are. Yesterday's action was not really unsurprising at all. And again, we continue to kind of trace out what we saw in 2022 more than anything else. So kind of the analog, so to speak, between what's going on in the markets right now and the 2022 decline are very similar. So again, we've had this decline. We came down, tested support kind of at the long-term moving average, which has kind of been the running trend of the markets here for a while. Here's the decline in 2022, came down and tested that level as well. Bounced off of it, and now likely we are going to come back down and retest these recent lows, maybe even set lower lows, potentially, somewhere around 4,800-ish on the S&P. Could be the ultimate low, kind of the ultimate bottom for the market. So there's certainly some downside risk here. And again, this market had this big rally. Now we're starting to work our way back down. That's very similar to kind of what we saw here in 2022. You had this down, you tested support, came up, had a decent rally, got above moving averages, and this got everybody kind of excited. This was when the Fed was expected to cut rates, and then the Fed comes out and says, no, we're not cutting rates. Markets come down, test support here at this moving average. And again, where we are now, very similar, is that we are as deeply oversold right now in the markets as we were back in 2022. So we've got this very, very deep oversold condition that kind of aligns with this first initial bottom that we took in 2022. So this kind of what I'm talking about here is any piece of good news, it gives you a decent rally, lets you reduce some exposure here. We come back down, retest that support potentially one more time, and then that ends the correction and we'll be done. And supposedly, the market will start to kind of heal up and move forward from here. But again, we're kind of still tracing out this very similar pattern that we saw back in 2022. But importantly, Markets are extremely oversold. This is a weekly chart, by the way, so things are slowed down a bit. So to get this oversold on a weekly basis is something worth paying attention to, because it doesn't happen that often on a weekly basis. And even when we take a look at shorter term time frames as well, you're seeing that same type of very, very oversold condition. So any type of just positive news here in the short term is certainly going to lead to a reflexive rally to some degree. But coming back just to talk about other markets as well, we're continuing to see as of yesterday as well, and again as we kind of talked about, we have seen this market kind of run. We saw volatility spike up. Volatility's been dropping, and as we continue to watch what's happening here with the markets, and again this is kind of the key. Markets are really oversold and here. So again, that also suggests that stress is getting relieved in the overall markets. So we'll continue to watch that closely. But also just taking a look at just general deviations of markets, we're very, very oversold again. We're pushing 2 standard deviations. We actually got down to 3 standard deviations oversold before that bounce that we saw previously, but we're back here towards the lows, starting to see a bit of an upturn in some of the money flow market indicators as well. So we're starting to see some money come in. Yesterday, very late in the day, markets were down about 3% around late afternoon, rallied back in the afternoon. We saw some institutional buying starting to come into the markets. Markets are up today. So again, just be a little bit cautious being too overly bearish right now. Markets are trying to find a level of support here, and wherever they find that support will be kind of a key point to be paying attention to. That's what you need to know before the bell this morning. We'll come back, pick up with John Penn, and why managing your money like a Vulcan might actually be the right thing to do. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds? Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away? Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things that, obviously kind of going on is that, and we've talked about this before, is that, we tend to make very emotional decisions when it comes to managing money, or just, and really, with John Penn here this morning. John, how are you?
Good. Good morning.
Good morning. Even with just overall financial planning, we make very emotionally driven mistakes. And again, I'm kind of just looking in chat this morning, and there's just a lot of comments in chat like, "Oh, you're only down 100,000." Well, you have to keep those things in context, because you have to look at that. Well, okay, great, you're down 100,000. That sounds terrible. I mean, it's, oh my gosh, I'm down $100,000. You have to put that in context, though. Is that on a $100,000 account? That would be bad if you're down $100,000 account.
I would say that would not be a good year so far.
That would not be a good year. But if you're down 100,000 on 5 million, that's not bad.
No,
right?
Considering everything that's going on so far this year.
Yeah. So, and again, it's just, I was having a conversation with a gentleman just the other day, and, very, very large account. His account's down 0.72 for the year.
Yeah. And
the market's down nearly 14% for the year. And, and again, I get it, right? Nobody wants to lose money in the markets, but, volatility is the price that we pay to invest and make money long term. And so, yeah, these near-term volatility events they're not fun, right? And unfortunately, the media doesn't help, because it just inundates us with all of these headlines of the most dire potential outcomes that historically never occur, right? But they certainly sound great. And they don't sound great. They sound terrible. And that feeds into our fears and leads us to making more emotionally based decisions, which tend to compound the problems that we have to begin with.
Yeah, it's all about making that knee-jerk reaction, right? I mean, I get it. Look, this year has not been fun so far. I don't know too many folks out there that enjoy, going through market volatility. I've seen quite a bit of it in my own career. But what's interesting is during this period of time, Lance, I just find it interesting that it seems like sentiment out there, and I've said this before, the sentiment during this market volatility feels almost like the sentiment that was in place like back during the great financial crisis. It seems like sentiment is really elevated. I think investors right now are just extremely, extremely sensitive to headlines. Mm-hmm. And so those headlines come out, and it forces you to make those knee-jerk reactions. But you were talking about like looking at a year so far this year where the S&P's down 12, through yesterday the Nasdaq's down 15. You got to remember, if you're trying to, looking at your lifespan, if you need your portfolio to support you for the next 20, 25, 30 years, I mean, you want to have some of the, depending on your situation, everybody's different, but, if you're setting up your portfolio for some growth to sustain you for the next 20, 25, 30 years or more, you need, to have some exposure to equity so you can fight purchasing power, fight inflation, do the things that you and your significant other want to do. You got to be able to accept some volatility here in the short term, but we got to be able to bring it all back and focus on the bigger picture.
Exactly.
Right?
Brent, could you bring up this Wall Street Journal headline for me? So this is just my point, right, of what we're talking about this morning. The market's down about 13% for the year.
Yeah,
it's that's a normal correction within markets in any given year. And just remember, we had, and this is what's really kind of fascinating to me, right? Do you not remember that we had a 10% correction last summer when we had the whole yen carry trade blow up? Do you not forget that we had an 8.5% correction the summer before that over concerns in the markets? And it was the AI, debacle, blah, blah, blah. Right? We have these corrections all the time, but every time these come out, it's like, oh my gosh, it's the end of the world. And then the market bottom starts to go up again. We forget this stuff. But this was a headline in the Wall Street Journal today. Dow headed for worst April since 1932. Of course, that was a depression.
Yeah.
Right? So what does that tell you? It tells you nothing. It just means that we're having a correction, and it's fairly significant. We've down 13% for the year. But, but that kind of stuff right there just immediately feeds into that whole, oh my gosh, are we going into another depression? No, we're not going into another depression. We're not. The economy's still doing fine, and unemployment remains low, and there's no indicator that that's changing right now to any great degree. Now, sure, could something happen and we wind up, in a much bigger, drawn out credit related event like 1932 or 2008? sure, something could happen, but there's no evidence of any financial stress in the markets right now that would suggest that that would be occurring. We've looked at credit spreads before, and yes, credit spreads have ticked up a little bit because of volatility in the markets. You would expect that. But credit spreads are not blowing out, suggesting that there is stress in the financial markets. And if there was, the Federal Reserve would not be fighting with President Trump right now over cutting rates. They would just be cutting rates and killing off QT entirely.
Yeah, I mean, over the last, really for the year, the folks that I've been visiting with that are most concerned with this market volatility are folks who are either one, they're in retirement, or they're nearing retirement. Maybe they're 3 to 5 years away from retirement. And retirement's very vague. It means a lot. It's so different for everybody. It's rarely that somebody just wants to stop working. It's just that they want to work less, or they want to kind of work under their own terms and have a lot more flexibility with their schedule. But there's also another group of folks that I've been visiting with too this year, and those are sons and daughters of clients, and their sons and daughters are in their late 20s, early to mid 30s, and they've really they haven't seen a lot of volatility with their investing career. I mean, they went through 2022. But that's about it from a volatility standpoint. So they're asking me, well, John, I haven't seen a lot of volatility. How do I need to think about this? And for them, I'm telling them, this is such an opportunity for you because markets are on sale. So I'm trying to really drill into the kind of the younger generation, the folks that are behind us with investing, that when markets pull down like this, don't forego contributing to your 401k or your Roth 401k if you've got one. I mean, equities are on sale. Could they go lower? Yes, but use it. Don't let the media scare you from this. This is an opportunity where you should be excited because you can get your money to work at better prices.
Yep.
Right?
In the chat right now, while we're having this conversation, Eric posted out, he says, the numbers are cooked. Talking about the economic data. Eric, it doesn't matter if they're cooked or not, because all the market cares about is the numbers, right? So you may not believe the unemployment number, you may not believe the inflation number, you may not believe the PPI number, whatever number it is that you think is cooked, but it doesn't matter because what the markets pay attention to is that number. So you can fight it all you want, but it doesn't change the dynamic that the markets are focusing on those numbers. And as long as those numbers are suggestive of a more positive outcome in the future, not today, not tomorrow, not next week, but in the future, the markets are going to trade off of that. And this is something we actually addressed today just a bit in our daily market commentary, because PEs right now are falling very, very rapidly because earnings estimates are not being cut dramatically. In fact, this was, I went to S&P. So S&P Global is the company that produces the S&P 500 index. So, and FactSet and a lot of those people produce estimates for the S&P, which is fine, but I go to the source of the company that produces the index and says, well, what are your estimates? Because you're the one that built this index. You're the one that's doing this. Sam Stovall's been running that department for as long as I can remember right now for S&P Global. But they just revised their estimates for April the 15th, as of April the 15th. So this is the latest earning data for that. Not only are estimates still tracking higher right now into 2026, they actually raised estimates from 283 to 292. I can't read that far away, to $292 a share. So they raised estimates for the rest of this year and into next year for the S&P. So if there is a concern about the impact of tariffs, slower economic growth, etc., S&P is not picking that up yet in the earnings estimates. Now, look, let me just be clear. These estimates are going to come down in the future. They always do. They're always high, and then they get revised lower later as we get closer to earnings. But the point is that valuations right now, I'm going to go to the next chart, Brent, are dropping rapidly because the P is coming down, but the E is remaining fairly stagnant. So we're now back to, valuations have now dropped in the S&P back to their long-term median going back to 2000. So, again, if this market declines further and the E's don't get revised dramatically lower, these valuations are going to get a lot cheaper very quick because the P of what's happening with the price of the market. Now, if earnings start getting slashed because we're starting to actually go into a recession or whatever, that's going to be different. And that will get reflected back into the markets. But as of right now, the analysts that build the index are not expecting a deep recession in the economy, and whatever slowdown occurs from tariffs is going to be temporary, and then the markets are going to go back to growing earnings. So again, that's just what's happening, kind of behind the scenes. But that's incredibly important to the outlook for investing because markets trade off of forward earnings expectations. That's what drives markets over time. Anyway, quick break. We'll come back, talk about being a Vulcan with your investments. Don't go away. Actually, there's an article that was written about it that we'll talk about. It's quite interesting, actually. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Can we get to really big news today? Important news. Today is 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah, so 110 years. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
The Real Investment Show podcast.
When's the last time you had an Oreo?
1911.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So there was an article that was written. When was this, John? Was this back in like 1990?
Circa 2019.
It's 1990. Sorry. Back in 1990, they were still chiseling stuff out on stone tablets.
We were using carrier pigeons
exactly.
back then.
Yeah, 2019. There was an article written that said investment lessons from a Vulcan. Mr. Spock is your financial advisor. It's a really interesting article. If you want to go Google it, this was a Forbes article, and again, it's called "Investment Lessons from a Vulcan." If you want to read the whole article, I may rewrite this article for the website as well, maybe in the next week or so. Because again, it's kind of an interesting article from the standpoint that it really kind of goes along with a lot of what we talk about. Is just taking your emotions out of managing your investments, managing your money. Because that's where we make all of our mistakes.
Yeah. So this came to mind within the last week or so as I've been, visiting with clients, individuals, and families that we work with. Visiting with maybe folks who aren't clients yet. Just talking with them about their financial situation. Client that we work with, Lance. We were talking about the markets and the emotions and all the headlines and. He just flat out told me, he's like, John, no wonder why people are all up in arms. We're not Spock.
Yeah.
And I was like, what? Let's talk a little bit more about it. I said, that is so good. I said, I'm going to take that because he listens to the show on a regular basis. So I hope he's listening this morning. But he's right. He's like, we're not Spock. We as humans, we're just wired. Money is very emotional, right? And so I was like, well, I thought that was a really great comment that he made. So I was out there looking for information and articles, and I found this one from Forbes. And, so it's, investment lessons from a Vulcan, and there were a couple takeaways here, right? So the first one was, it's curious how often, so if this was Spock talking, it's curious how often you humans manage to obtain that which you do not want, right? So it starts talking about when it comes to our finances, we all know, right, the kind of the basics. We should avoid debt. We need to have an emergency fund. We talk about having a cash cushion all the time, right? And depending upon where you are in your investing career, is it 3 months, 6 months? Maybe you're a little bit closer to retirement, or you're in retirement. Maybe you have a good 2 years worth of living expenses set off to the side, right? That you can pull from so that when volatility happens, like right now, you've got funds that you can pull from that are supplying that paycheck to you on a regular basis. And that you've got a good 2 years or so worth of living expenses set aside, so that way you can allow this market volatility to subside and let your portfolio recover. Because the last thing you want to do is just raise cash for your living expenses at a time where securities in your portfolio are down.
Right. This is something we talk about a lot because this is, and back in 2008 is a really good example. Short-term corrections aren't an issue, right? This is a short-term correction. This will be over, and then we're going to go on with the markets for the time being. But when you get into a longer-term structural bear market like 2008 or like the dot-com crash, it becomes really important to have that cushion because if the markets are down 10% and you're taking off, let's say you're withdrawing 5% a year to live on, you're not down just 15%, right? You're compounding the loss because you're withdrawing over, as the markets are declining, you're compounding that loss by taking money out of the market at the same time. So it really works the downside. So you need to have this liquidity source that you can go to and say, look, I'm not going to touch my portfolio right now, or I'm going to take some of this money, I'm going to put it over my portfolio and buy low where you're supposed to be. But I'm going to have this other liquidity source that I can live off of during these periods and during those down market years, that's where you've got to, we were going to travel this year. Hey, we're going to postpone that. Rich and Danny and John were doing a great job last year, in particular with financial plans when, we were up two big years in a row. Portfolios had done great over the last 2 years. Markets were up 20% a year. We were telling people, hey, take money out now. Go do your remodel. Go do your, go build out your kitchen. Go take that trip. Go do that now. Let's take that money while we've got it, because eventually we're going to get into this period of volatility again, like we talked about earlier this year. But this is the point, and of this whole structure, which is we do more to self-sabotage ourselves.
Yes.
Through our emotional biases of making these emotionally driven mistakes in portfolios. This is the time to actually be looking for bargains, but we don't want to do that. We're just too worried about the headlines and this and that and the other thing, rather than stepping back. And look, I'm just as emotional as everybody else. So it's really hard for me, just like you, to sit there and go, okay, hey, there's an opportunity in this stock or in this company or in this market, to go take advantage of it. And at the same time, also recognizing that things that have gone up a lot in this market are also going to mean revert when the market changes course. So there's, you've got to be aware of all these things and take all this emotional bias out of it, because that's how we set it. This is how we self-sabotage ourselves.
Yeah. So when you start to feel that stress come on, right? You, rather than making that just that quick knee-jerk reaction. So what Mr. Spock would advise you to do is to take a step back, take a deep breath, and try to look at this from a logical standpoint. It's like, right, so if I go to the grocery store and I see something in there that is typically at a higher price and now it's on sale, well, then my natural inclination is I'm going to buy it because it's at a cheaper price. It should be the same way with stocks and bonds, but for whatever reason, as investors, we tend to work in the exact opposite. So another takeaway here from the article was that insufficient facts always invite danger. Right. So trying to make decisions for your portfolio, or not just your portfolio, but just for your financial life, right? Your financial health, with only partial information will almost always go wrong. Right. So the article mentions that is why so many quote unquote hot stock tips, turn out to be a bad decision for investors. So it kind of gets back to, looking at, common sense and before you invest in a security, whether if it's an individual stock, if it's an exchange traded fund, if it's a mutual fund, if you're looking to put money into an annuity or some sort of an insurance policy, whatever that might be, have a good understanding about what that investment is or what the structure is that you're about to put your money into. So that way, if for some reason, if it doesn't work out as intended, one, are you able to get out? Is your money liquid? Before you put your money into an investment, you need to make sure you make an informed decision, right? Because I still, to this day, Lance, there are many folks that I visit with where, they don't, they come to us because they are in a portfolio of securities that their other advisor put them into. And then when I visit with them, it's not surprising for me to hear, John, I don't even know how I got this stuff. I don't even know what this is, right? Like, what are these bonds in here? What are these mortgage-backed securities, and why are they going to zero? I'm like, well, hold on. I know we've talked about this a lot, but and I'll go through the portfolio and look at all the investments with the individual or family. And most of the time they'll say, nobody's ever explained it to me that way before. Right. I've never really had a good understanding on how this worked, right?
For instance, I love mortgage-backed bonds.
Yeah.
And I wish people understood them, because they're one of the greatest investments on the planet, but nobody understands them.
Right.
Because all they do is they just see the red on their portfolio, because every month you're getting a principal payment back, which is reducing the principal value, but the brokerage statements don't adjust for the principal repayment. So all you do is just see red. And it's like, I'm just losing all my money. Yeah, that bond's going to go to zero, just like a mortgage. Eventually, you're going to pay it off.
You're paying it off.
Yeah, but there's some investments you can never explain to people,
right?
No matter how you do it.
Well, yeah, and that's why it's so important to. And I know you say this all the time. Know what you own, right?
Yeah.
Know what you own. How does this work? And so and there's a lot of the hot stock tips going on out there right now, right? Because I hear about it from folks that I'm visiting with too. Hey, my neighbor said this, or it was just Easter, so I already knew what conversations would be like as folks were sitting around the table around their crab boil or whatever it might be, right? So just before you make that decision, understand the investment or the structure that you're putting your money into. Another great takeaway, so true, in critical moments, volatile periods and critical moments, humans sometimes see exactly what they wish to see. So true. So we're opening up our account statements right now. We're looking online. What is if we're worried about volatility and stress, what are we going to look at first? Are we going to look at the numbers that are in green on the screen or in red?
Red.
Absolutely. Every time.
Every
right?
time. Yeah.
Every time.
So and the problem is again, that's the only thing we focus on. It doesn't matter all the stuff that I'm making money on. I don't even worry about that. I just worry about the one that I'm losing money on.
Exactly.
Yeah.
And there are, when you're focusing on, if I could kind of relate this to a forest, you're trying to focus on too many of the individual trees, and you got to take a step above. You got to look at the forest overall, right? Because there are many things in that forest in your portfolio that are probably doing pretty well this year, right? Mm-hmm. But it's just very easy to kind of not really nitpick, but really drill down and focus on those items in your portfolio that are red. But in the world of investing, as you know, things don't always move in the same direction at the same time.
Well, and your portfolio should be built exactly that way, so that you have some assets that don't move in the same direction as other assets. But again, that's very, very hard, because when you have that, now your portfolio is going to underperform an all equity benchmark. So now you're complaining about the fact that, well, I'm not beating the index, but you have lower risk, and you have to look at risk adjusted returns. But we don't do that, because we only see what excites us, or what we want to see.
Correct.
This is all the problems that we wind up getting ourselves into, and this is why the average investor over the last 50 years consistently underperforms investing over time, because of all these things we're talking about. All right, we're going to come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Real quick, I want to finish up this conversation on being a Vulcan. Brent, can you bring up this chart for me real quick? Just the top two panels. So just some conversation. This is one of the things it kind of goes to the heart of what we're talking about in terms of allowing headlines and emotions to drive your investments. This is a chart of the dollar. It's the monthly chart going back to the 1970s. Everybody's talking about this morning. It's like the dollar's declining and it tells all about the world. It's too much debt. This is a dollar. Since 2012, the dollar's been in a really steady uptrend, still is, hasn't broken that uptrend yet. There's absolutely no concern about the dollar, de-dollarization, anything else. It's just a decline. If you'll take a look at the top panel of that chart, that's the relative strength index. It was extremely overbought on a monthly basis back in 2022, 2023. We're just correcting that overbought condition. That's all that's happening. The dollar is just an exchange between other currencies worldwide. So at the moment right now, because you have tariffs, because you have these concerns over economic growth in the U.S., et cetera, it's not surprising that foreigners are pulling their capital back. As the dollar declines here, that makes things more expensive for them, stuff they want to buy. So they pull the currency back out. Because if I'm storing my reserves in U.S. dollars, then I'm losing money because the dollar's declining. And so I pull that currency back, which exacerbates the decline a bit. But as soon as the market bottoms, as soon as we see a turn in markets, as soon as we see a turn in economic growth, et cetera, that money comes right back in. And this has been the case. And more importantly, this has been over time. We've just seen repeated conversations about this. Yes, there are periods where the dollar declines. Dollar's trading where it was in the 1970s. Regardless of the debt, regardless of the deficits, regardless of all this other nonsense that people want to try to attribute to it, it's just the dollar. It's just how it trades relative to other currencies. It's still 70% of global transactions. That hasn't changed since 1980. It's still the dollar reserve. That's not changing anytime soon because there's no other currency that has liquidity or depth to handle the amount of transactions that occur every single day. If you want to buy gold, anywhere in the world, you buy it in dollars. You want to buy oil, anywhere in the world, you buy it in dollars. That's it. So again, this is the whole point about separating out emotional-driven headlines and your investing. And again, when you have the dollar getting this oversold, and this is a monthly chart, but if you get on the daily chart of this, the dollar is extremely oversold, you're going to have a counter trend rally in the dollar. So everything that is a long dollar trade, such as gold, oil, etc., that gets under pressure as the dollar rallies because now those assets become more expensive. So again, just set aside all of these narratives that have no relationship with realities and how markets work. And you'll do yourself a lot of favors.
Yeah, I mean, there's been several conversations this year that I've had around the dollar, and with the weaker dollar as of late, that kind of that headline or the question of the de-dollarization of America tends to kind of spike in times like that. And excuse me, 20, 30 years from now, 20 or 30 years from now, will the dollar still be the world reserve currency? Not sure. Right now, it is, right? And I think folks, Lance, are concerned out there that we're just going to wake up one morning and all of a sudden the dollar is no longer the world reserve currency. Like it's just going to happen overnight.
Yeah, it doesn't happen that way.
Right? I mean, if something were to change, there would be some clear trends and clear indicators that this would be going on. It's not like we're just going to wake up tomorrow morning and all of a sudden the dollar's not the world reserve currency, right? So you got to use, that's where you kind of take the step back and just try to apply some logic there. Same thing with gold. There are many clients, many individuals and families that I work with, they have a piece of their overall portfolio allocated to gold. It's just a diversifier. Mm-hmm. But I've had a lot of folks, not our clients, but I've had a lot of, interested clients say, I've heard this over and over again this year. John, I'm really tired of the market volatility. I don't know if I can handle a lot of speculation. I don't like the pull down in equities, so I'm going to go into a more safe portfolio. I'm going to shift all of my money over to gold and gold miners.
Perfect.
And I say, okay, let's talk about that a little bit here, right? So you can almost see the narrative. You can almost see the story unfolding here when you look at the chart of gold. Mm-hmm. I mean, so if you were to look at the chart of gold or gold miners and compare that maybe to like the S&P or maybe the NASDAQ, where do you think Mr. Spock would tell you to kind of take some profits and maybe add some money into right now from a logical standpoint, right?
Right.
So it's that herding mentality, so folks you still want to kind of follow the herd out there and just you got to be so careful about that. You got to look at this from a balance standpoint. Right before the last break, Lance, you were talking a little bit about, how investors, they underperform a benchmark, right?
Right.
And to this day, too many investors, they benchmark themselves against the Standard & Poor's 500 index or like an all equity index. And it's not a fair apples to apples comparison. Because a lot of the folks that I visit with, they don't have a 100% equity portfolio, right? So try, quit comparing yourself to an all equity based index. At the end of the day, you are your benchmark. You need to grade what is the performance that you need for your financial plan to be successful. That is your benchmark, right? So, we as investors, we're also trained to compare ourselves to that of the S&P, and it's just not an apples to apples comparison. Right. So I had to mention that this morning.
No, that's true. Now let's shift gears here a little bit. One of there's an article out this morning, and these bug me. These type of articles bug me the most. Is how much money do you need for retirement? You need 25 times your salary.
What's your number?
What's your number, right? So 25 times your salary. If you make $100,000 a year, if you have $2.5 million, you're good to go, right? Here's the huge problem with that. That's today, right? So let's say you're 30 years old, you're gonna retire at 65. You go, oh look, if I just have 25 times my salary saved up, I could retire early. Sounds great. Problem is 2.5 million is about 4 million in 30 years, or 5 million in 30 years, right? Whatever. I mean, that number is going to change because of inflation over time. So 25 times your salary today, or they talking about 25 times your salary when you actually retire, right? Those are two very, very different things. And the other side of this is the most important aspect. Depending on what, right? If I have friends of mine that live on $2,000 a month.
Yeah.
Right? $2,500 a month. I have friends of mine that have one guy that spends $1 million a year to support his wife. So, it depends on what your needs are. If you're spending $1 million a year to live, you're going to need a whole lot of money.
You're going to need a lot of zeros in your balance.
You're going to need a couple of, you're going to need like 2 or 3 commas to support that. Yeah. So, but these are the problem with these articles. It sounds great in nature, and also depends on where you live. Every state in the U.S. has a different living standard in it. I mean, you can go live in West Virginia pretty cheap, right? You live in California, it's going to cost you a lot. So where you live also has a really big impact on how much money you need for retirement.
Yeah, I mean, just look at like my parents, for example. I mean, when we moved to Texas, we moved to Dallas. That's where I went to junior high school, and probably about 10 years ago, my mom and dad sold their home in Dallas, and they bought a small little lake house out in Lake Athens, Texas, just outside of Tyler. They love it. Smaller, more rural community. They count the deer during the day, count the stars at night, and their property taxes are a lot less, utilities are a lot less, just cost of living is much lower, right? And they're very happy there. And so not one state to another, there's some big degrees in variance in what your living expenses are, but just within your own state, there you can look for opportunities where you can just save on your living expenses, property taxes, homeowners insurance, all of that, right? There's a great degree of variance there. But yeah, Lance, I get this number a lot, especially if we're doing an interview for like the local news stations or what have you. They try to hit you with, well, John, what does that number need to be? How much money does somebody need in their account to retire? And I have to take a deep breath under the mic and hope that they can't hear me. I'm just like, of all the questions to ask, this is the one, right? But it's a very, it's a very common question.
It's the one that everybody wants to know. It's can I retire? Everybody just wants to know, do they have enough money to retire? I want to know. I keep asking Danny if I can retire.
No, we have disabled your financial plan. Yeah. You're not allowed to look at it.
So, but that's the question. Everybody just wants to quit working, and I don't blame them, right?
Well, I think they want to work less. I find that folks still want to be engaged and involved to a certain degree.
Well, sure.
And have that purpose.
I want to do something I enjoy doing.
That's it. But
not sit in Houston traffic an hour a day.
Yeah.
Right?
And they still want to have some income coming in, but maybe they're not to the income that they're used to or accustomed to. I think the biggest concerns when it comes to, hey, can I retire? I think a lot of times folks are, what they're really asking are, am I going to outlive my dog? Am I going to outlive my assets? Then the second big question that they're really wanting to get to without admitting it is, am I going to be a burden to my loved ones? That's what they're at. Sometimes it's, John, hey, I just want to make sure I don't outlive these assets, and I just want to make sure I don't become a burden to my children. That's when we're really getting down to the heart of the matter right there in those conversations. Right?
Well, and this goes back to the other conversations that I have with people all the time is like, well, I have to pay for my kids' college. I have to pay for my kids' car. I've got to go bail my kids out of their credit card debt, et cetera. It's like, no, you don't. And the thing you need to think about is that if you spend all your money now bailing out your kids, you're going to be living with them. Is that the burden you want to put on them?
Yeah.
In the future.
Exactly.
Then, again, choices we make.
Mm-hmm.
Like, be a Vulcan.
Be like Spock.
Be like Spock. All right, wraps up the show for today. Thanks for joining. Be sure and like and subscribe to the channel. Appreciate it very much. We'll be back here tomorrow with Danny Ratliff, picking up on the markets. Futures are pointing higher right now across the board. Some positive news on tariffs will certainly help the markets a bit here. So we'll be watching that closely. And our earnings, next week in particular, earnings, big. Week after that, stock buybacks come back. So keep that in mind also. All right, see you tomorrow.